Hello, this is Paul at OUTPACEsys, and this is our report for the week ending on April 25th of 2008. We will be providing status and trends on the major components of the financial markets. We'll talk about the indices and key sectors of the market and report on the performance of specific industries and trends in international markets as well. These are the data that feed our analytical models upon which we base our trading approach. In the interest of not wasting anybody's time, we keep these notes very concise and to the point, but we do strive to provide a clear indication on the identified trends. We start looking at the major indices. This is the Dow Jones Industrials, and it's a weekly chart. Next, this is the SP 500 and the Nasdaq 100. Although the absolute variations have had quite different magnitude. This week gave a welcome confirmation to the recent recovery from the severe correction of the last 2 quarters. I'm sure you do recall this major correction that happened in the last quarter of 2007 and the first quarter of 2008. This new short-term uptrend that we're seeing is certainly heartwarming news, since, as we said in previous reports, that correction has been very close to becoming a fully fledged recession-type bear market. Now we are hitting some resistance, and we are quite far still from a true upmarket configuration. So, while we hope that this continues this way, we will remain very careful in assessing the upcoming developments. Our indicators show the market as being in a short-term, moderately bullish posture, although the long-term trend is caught in a range still, and is quite vulnerable to a downtrend. In the next period, we will favor short-term long trades, but capital for long-term opportunities remains in cash. In other words, we will be waiting for this trend to confirm before we invest on the long term. Let's switch to the bond markets. Both long-term treasuries and investment-grade corporate bonds have been trading in a range for the past 6-8 months. We are now looking at a small bias to the downside. We have had a lot more action in these other markets. If we look at oil seems to be unstoppable at this point in its race upwards and is continuing the uptrend that has started early in 2007. That uptrend was slowing down briefly in the last quarter of 2007 and at the beginning of 2008, but has now started again with a vengeance, and although nothing is irreversible in the markets, the trend is still up. For now, we remain long on oil, and that is easing the pain that we suffer when we go to the pump and fill up, but we would not recommend starting any new long positions now. Gold is another story. After reaching historical highs at the beginning of this year, the last several weeks have seen a pause in the fast and furious growth. So, while the long-term trend is still strongly positive, the short-term and the intermediate-term approach have to be more cautious. Next week, we will be still looking at short positions in our short-term trades. Let us look now at the ETF world. As you know, we do like ETFs a lot because of the great variety that they afford, and the fact that with the proper usage of ETF you can build up a very diversified portfolio. This chart reports the 5 best and 5 worst, including all categories. In the 5 best we find natural resources, in particular coal, communications, China stock, gold, and real estate, and China real estate. What is the gold fund doing there in the 5 best when we just said that gold is going down? Well, this is a double short ETN, so it's a leverage shorting fund which performs best when the gold goes down. Not by coincidence, there's another gold entry in the 5 worst, this being the double long ETN, which is the brother of the one that we saw in the other group. The other entries in the 5 worst are Europe stock and another entry that has to do with gold miners, telecommunications and China funds. These last two are ultra short and that's why they are in this group. Switching to the country-specific funds, the 5 best include Hong Kong, South Korea, Sweden, Australia, Malaysia. The 5 worst include Japan, Canada, Holland, Taiwan and Mexico. The ranges in these funds, the 5 best have increased from 1.3 to 3.5 approximately % for the week, whereas the worst 5 have gone down between 1.5 and 2.8%. In this chart we are looking at the 5 best and 5 worst industries for the week. We do like this chart because as you know, when we spend a lot of time to identify a good stock via its fundamentals and we want to invest in it, we definitely will hold on that investment if the group that it belongs to is not faring well. This week the 5 best include agricultural chemicals, independent oil and gas, steel and iron, non-metallic mineral mining, and farm construction machinery. The 5 worst include newspapers, radio, title insurance, toy and hobby stores, major airlines. In this chart we are looking at the 5 best and 5 worst industry groups. When we spend a lot of time finding good companies via their fundamentals, we don't want to invest on them unless their industry group is faring well. This week the 5 best include agricultural chemicals, oil and gas, steel and iron, mineral mining and farm construction machinery. The 5 worst include newspapers, radio, title insurance, toy and hobby stores and major airlines. I'm taking a trip this week. I hope this doesn't affect the safety of my plane. We close briefly looking at the portfolio and our trades. As we have reported separately, we have closed recently several successful positions that had reached their profit goals. This past Friday we just opened a long position in the Qs, and in its first day it closed at a nice little profit of 5%. Of course the trade is still open because there was no reason to close it, and we will be reporting on this in the future. Overall, in the next period we will be favoring short-term bullish trades. This is it for this week. If you would like additional information, please visit our website at OUTPACEsys.com. We will be talking to you again next week. Happy trading!